All right, I'd like to call to order I believe this is a regularly scheduled meeting of the Kentucky Retirement System Investment Committee. And Sherry, am I correct? This is our last of this fiscal year?
Yes.
I
Yes.
was looking, I didn't see another one. So given that where the stock market is at the present time, can we just call it a close here? Or we're not allowed to do that, are we? Um, so in any case with that, we are down to the opening legal statement.
Yes, sir. For the record, I want to note that this is a regular meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Sherry, would you call the roll?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins,
Here.
Ms. Bova,
Here.
and Ms. Thompson.
Here.
Thank you.
And we do have a quorum, it appears. Any public comments?
No, sir, no public comment today.
All right. And that takes us to the approval of the minutes of the February meeting. I'm sure everyone has had these in due time, and any modifications, changes that anyone has on the minutes?
Move approval, Mr. Chairman.
Any objection to approval? Hearing none, the minutes are approved, and I see Pam has joined us.
I was going to say you need a second for the motion, though. Sorry, sir.
Oh, okay.
I'll second that. Approval.
Thank you. And but we don't have to do a roll call on that. So if no objection, the minutes are approved. And I guess I did notice that Pam had joined us. Thank you.
Yep, I was on the roll call. Yep.
Good. So let's see, our next item. I've lost my agenda here. Just a second here, sorry. The next item is the discussion of adjusting, I guess is a better term, our benchmark on the public equities we use. And I won't get into the weeds and details because Joe and Steve done a great job on this. I will say that this is one of those technical things that that is, if you read the investment policy statements, this is the kind of decisions that, in my opinion, we want made at the staff level, and then brought to the attention and recognition by the boards, rather than getting into whys and hows. But what has happened here in summary is that the staff wants to move from the S&P 500 to the Russell 500. There were some structural issues that have always been involved in the S&P 500, but more recently they've raised the price of the licensing, and we don't like people raising prices. And so with that, Steve, do you want to talk on this? Joe's done a lot of the legwork too, so I'd like to hear from both of you.
Sure. And as Pruitt mentioned, this is really an information only item. We wanted to provide an update. As you mentioned, we are changing the benchmark for the U.S. public equity large cap internally managed passive portfolio from the S&P 500 to the Russell 500. Joe's produced a memo here that's included, and I'll let him cover it in detail, and then happy to answer any questions. So, Joe?
All right. Well, thank you. Like I said, we're advocating for a change from the S&P 5 to the Russell 5. Excuse me. And just as a bit of background, so roughly 40% of our global equity mandate is managed in-house. Of that, the vast majority, call it close to 90%, is in the U.S. Large cap mandate that we manage against the S&P 500. It's passive. We fully replicate it. We've done it for several years, and it's been fine. There is a bit of an issue from a structure perspective in that the remainder of our U.S. mandates are benchmarked against one of the Russell indices in that family. And because the S&P and Russell use a little bit different methodology when constructing their indices, there's the potential for a little bit of a mismatch in the market cap as far as where they draw those lines between small, mid, large, for instance. And so when we use two different vendors, we have the potential for an unintended market cap tilt. So this has been something that's we've been aware of. It's never been an issue for us because we were aware of it. And so it's never been a real high nail, as Mr. Lane alluded to. We were contacted by Dow Jones S&P to discuss our relationship, which is we have found when people do that, it's synonymous for we would like more money. And so that kind of made that nail stand up a little higher at this point. We currently pay them a flat fee of a roughly $27,500 annually. Wanted to institute not only a flat fee, but a variable fee that would move alongside with the assets under management that we run here. Given where we currently sit, that would make our annual fees close to $165,000. So that was a decent jump. We wanted to, because of that, we decided let's look at Russell 500 as a potential substitute, which we have looked at in the past. So one, it helps us from just managing the portfolio a little more efficiently, in that the market cap breaks would be more clean as we use Russell indices across the other mandates. Two, they have a flat $30,000 fee annually for all their U.S. indices. They are willing to lock that for a time period and even impose limitations on its ability to increase in the future. So that kind of solves that. But we don't want to make a change just to save fee dollars at the expense of potential performance. So we looked at performance. On any given year in the short term, there can be some deviations in performance between the two indices. Not significant. When you stretch that out over this longer term, 7 to 10 year plus annualized, you're looking at a handful of basis points that's actually in the Russell favor. So then we said, okay, if we're getting like performance, maybe a little bit better over the longer term, is that at the expense of additional risk in the portfolio? So we looked at volatility. They're basically in line with one another. So when you have like performance with like volatility, your Sharpe ratios are basically the same. So we said, okay, now we can be a little bit more efficient in the managing of the portfolio, save a few fee dollars. We don't give up any performance. We don't bring any additional risk really into the portfolio. So what is the cost to make this change? There's a ton of overlap between the two indices, which makes sense when you think about the performance and volatility basically being in line with one another. There's, of the 500 names, roughly a little over 430 are in common. So we'll call that a little over 85% of the names in common. However, those are in the larger names. So it's actually 97% of the indices when you look at it from a market cap perspective. So while there's 60 names that are different, they only make up about 3% of the actual indice. And so we believe the transition would be relatively easy. There's no need to engage a transition manager. It's something we can do in-house. We don't have to do a significant trading event all at once to make this happen. It can be done over the course of our normal rebalancing or cash raises as needed. So we don't view this as a difficult thing to implement, nor an expensive thing. So at the end of the day, this was more of an FYI. We're going to advocate, or we're planning to make the change from S&P 5 to Russell 5. We believe, once again, a little bit more efficient in the way we can manage the portfolio, save some fee dollars, very similar performance, if not a shade potentially better, volatility basically in line, and an easy transition on staff, and no real cost to the system to make that change. So I do see a hand raised.
Ramsey, you have a question?
Yes, sorry. Just out of curiosity, because I don't understand all the logistics of this, is this something that Wilshire could provide us with based on the fees that we pay them, or is this a completely separate?
It's a separate, they actually do have a separate line of business that provides indices. I don't think there'd be any additional fee savings or anything gained from the performance, but there would be the potential of, hey, you went to your consultant and just expanded the relationship. A little bit of a, does it look strange or not? We'd already started going down this path when Wilshire kind of kicked that potential to us. But they're on board. I don't know if they're on the call or not.
They
Steve,
are.
but okay. So Chris Tessman, talked to him.
No,
He'd
we're
be-
here. Craig and I are on the call. Sorry.
Okay, so I
Yep.
talked to Chris. I assume he's talked to David, but they're supportive of the move, and so it's like I said, it would be an expansion of the relationship with Wilshire if we were to go that route. So there's not a potential phase, paying Russell a fee that we wouldn't necessarily have to pay regardless of who the provider was. So,
And
Yeah,
as
that's-
Joe mentioned, sorry, David, as Joe mentioned, we've been discussing this in similar type moves for a while now. It wasn't a high nail because it wasn't something that was causing undue concern, but it really, the discussion prior to the fee implementation, or the request for an increased
So
fee was more in
was the
an
efficiency.
alignment. Yeah, it's an alignment across, again, when we look at the entirety of the public equity portfolio and specifically the US
Right.
part of the portfolio, the alignment of how those other parts of the portfolio are what they're being managed against. So this really is a better alignment with those other portfolios that
Right.
are being managed against.
So we
similar-
have all cap mandates that measure to the Russell 3000. We've got a Russell mid cap mandate. We've got a small cap that uses the Russell 2000. We have a micro cap manager that uses the Russell micro cap. So we're in the Russell family. They've poked their head up out of the sand by saying we want more money. Fine, we'll become more aligned with the current portfolio, and it's a little cleaner from an efficiency to manage perspective. So,
Joe, I've noticed over the years, just listening to, what you go through when the S&P does some rebalancing, and occasionally they have some pretty major rebalances as companies that weren't even in the index because of their peculiar definitions and qualifications. Is the Russell have any also likely to have major rebalances from time to time, or?
so yes, so S&P has a quarterly rebalance. That's kind of their formal schedule, though there can be ad hoc rebalances as adds and drops occur on any given. I could get a notification that as of 2 days from now, someone's dropping out of the index. Russell's more annually. They have one big reconstitution, though they still have a quarterly kind of cleanup trade. So the schedule of the trading is not going to be significantly different. Nothing that staff isn't used to or can't manage. The difference, I would say, is Russell's a little bit cleaner on their guidelines as to what qualifies for the index, and S&P's, they have rules. It's not that they don't, but it's a little more fuzzy. The bands are a little wider where names can kind of sit on that gray area. Is it a mid cap? Is it a large cap? And that can be included in both indices, whereas Russell is a little tighter on those bands. So it's a little bit cleaner indice probably. I don't know if that answered what you were looking for.
No, it does. That's precisely what I was wanting to hear, that it wasn't going to increase the complications.
I don't expect it to really change our day-to-day interaction much at all, to be honest. Performance, like I said, we expect to be, sitting right on top of each other. And basically it's makes things a little cleaner from a managing perspective and a little bit of fee savings at the end of the day. So.
Well, John, do you have a question,
Yeah.
comment?
My question is, how does this affect the comparability of prior results on a go-forward basis? Do we have to explain the difference every time?
No, well, there'll be a benchmark change, and so there will be a period where our extended performance is a blend of X years of Russell 5 and the historical stuff being an S&P 5. But you already have that. You may not be aware of it, but we've not always benchmarked to the S&P 5 and the large cap internal stuff. We have for several years, probably 8 to 10 at least. But prior to that, we used the S&P 1500. We didn't own all 1500. We optimized, so we held roughly 400 to 500 names in that account. So what you're seeing in that 20-year number is a blend of historical benchmarks. This will kind of follow suit as far as how it's treated. So all our historical performance will be there. It will be comparable as always.
And just one more question then. Is the Russell 500 weighted by capitalization? Like
Yes,
the-
sir. So the Russell 500 is all going to be your large cap. If you were to take, and it's a little cleaner, so instance, you take that 500, and then you might have heard the Russell 2500. That's kind of their mid and small cap. Well, you put 2500 to 500, and that's kind of their all cap Russell 3000, which is what our all cap managers utilize. So it's just a capital market classification. Yes, the top 500 names, very similar to the S&P 500.
But it is cap weighted and it's not equal weighted.
Correct. That's why that last 60 names only make up about 3% of the actual indice. So
Yeah, thank you.
Well, we did want to bring this certainly to the investment committee and to see if there are any questions. And we didn't ask, we're not asking for a vote here, but with your all's knowledge and permission, staff will move forward with this change.
Mr. Chair, what I learned from all of this is that when someone says they'd like to talk about their relationship, it just usually doesn't work out well. So that's been my experience too. So,
It's me, it's not you conversation. So
yeah, let's be friends. Let's just be friends.
Brian was on the call with me. I think he'll testify that there was a warning that they should not get overly silly with their adjustment, and in my opinion, they did. So
well, and certainly technically the correlation and the tracking, it looks like it's going to be relatively unchanged, but as Mr. Eager always counts the pennies and nickels for us, and you've done a nice cost savings there, and we're always looking to do that without any diminution of the quality of the work we're getting. So,
right.
Thank you, Chris.
Our next item is the investment, I guess, Steve, that's you.
yes, Sherry, could you go to page 18, please? Thank you. I think Wilshire's deck and the quarterly report that staff produced did a really good job of providing a backdrop of economic conditions and market conditions during the quarter. So I wanted to hit a couple of highlights, and then we'll dive into the portfolio. So for the quarter, growth assets had a very strong quarter on optimism. The Fed had successfully threaded the needle and arrested the inflation genie without inflicting too much damage on economic growth, and as continued optimism grew for the prospects of artificial intelligence or AI. Real GDP readings continued to be strong, printing 3.4% for the fourth quarter, with consumer spending remaining the major driver, contributing more than 2% to growth. U.S. exceptionalism stayed intact during the quarter, with U.S. public equities up almost 10%. Nearly every sector was positive, with communication services and energy producing the best performance. Small cap again underperformed large cap, this time by 230 basis points during the quarter, while growth stocks generally outperformed value. On the non-U.S. equity side, those equities were able to produce positive performance, but failed to keep pace with their U.S. counterparts, returning just under 5% for the quarter, with developed markets outperforming emerging markets. The European economy remained weaker, with consumers hesitant to spend, fewer exports, and lower investment, all reflecting diminished economic demand. Specialty credit, high yield, and levered loans all had a strong quarter, benefiting from the higher rate environment and tightening spreads. The traditional defensive market sectors were mixed for the quarter, with core income was down almost 1% as yields rose across maturities and the curve steepened. The 10-year Treasury yield ended the quarter at 4.20%, up 32 basis points from the end of December. Real estate securities were little changed during the first quarter, up slightly in the US, but down globally. Commodity results were positive for the quarter, with crude oil rising 16% and reaching its highest price since late summer 2023. Natural gas prices moved lower during the quarter, down almost 30%, the second straight big down quarter in a row. And gold was up over 7% for the quarter, rising above $2,200 an ounce. It's pretty rare to see gold above $2,000, and a lot of consternation on what that implies, either from a dollar perspective, from an inflation perspective, or from a flight to quality perspective. Page 42, please, Sherry. Thank you. For the quarter, the portfolios performed in line with expectations in their benchmarks. The KRS pension composite produced a return of 3.54% for the quarter, with the KERS and SPRS portfolios returning 3.37% and 3.41% respectively, while their benchmark returned 3.29%. The KERS Hazards portfolio returned 4.30% versus its benchmark return of 4.37%. The insurance portfolios all had similar performance, with returns ranging from 4.28% to 4.40% compared to the benchmark, which returned 4.37%. Fiscal year to date, performance has been strong for all of the portfolios, with the KRS pension composite producing a return of 8.53%, while the insurance composite has returned 9.71%. The public equity portfolio was the best performing asset class for the quarter, by a wide margin, producing a return of 8.22%, while real estate was the worst performing asset class, with the portfolio declining 4.24%. I also wanted to highlight the significant underperformance noted here of the private equity portfolio relative to its benchmark. You know, we've discussed this in the past, but I think this is obviously a pretty high nail, and I wanted to highlight it again. And that difference is primarily driven by the mismatch with the benchmark. As we know, the benchmark for our private equity portfolio is a public equity benchmark, lagged 1 quarter plus 3%, plus a bogey. And that's a very reasonable and appropriate benchmark. We've talked about this over the years, especially as we've done revisions to the IPS. You know, that's an appropriate benchmark over longer periods and especially over market cycles. But it may result in significant tracking error over shorter time periods, especially in more volatile markets, more up or more down. The dispersion between private equity and public equity can be pretty significant. Looking at private equity market data performance for the last quarter, we saw pretty significant variance, you know, across the different strategies that encompass that market space, ranging from down 2% to up about 2.5%. So if we look at buyouts versus venture, there was a pretty large dispersion. But to note there is that our private equity portfolio, you know, we know that we have some issues as far as vintage. There was an extended period where we were not investing in private equity for a number of the portfolios. So we do have a vintage issue there. We're not current, but the performance has been in line with other private equity investments. And it just comparing it to this public equity market benchmark plus a bogey makes it look pretty out of line. But I just wanted to ensure everyone that the performance of those investments are reasonable, especially given the vintage. Markets pulled back in April as signs of waning demand and sticky inflation called into question the soft landing narrative and jump-started the stagflation concerns. Expectations of a slower and shallower easing cycle drove growth assets down, even as defensive portfolios produced losses as yields rose across the maturity spectrum. For the month, public equities were down over 4%, core bonds were down 2.5%, and real estate markets were down over 6%. Commodities for the month of April were one of the few bright spots, up almost 3%. Performance for April is still very preliminary, but I wanted to give an update, and consistent with those softer markets, the portfolios are tracking down about 2 to 2.5% for the month. Obviously, we turn the page to May and things have gotten a little rosier. Public equities are back near or at all-time highs. We've seen a pullback in yields. And that's the ongoing conversation in the market. I think the material that we provided both in our quarterly and that Wilshire provided on economic conditions, that's the big debate in the markets currently is inflation, the path of inflation, and what that means as far as Fed actions, when we can expect easing. There was a period of time earlier this year when there was actually speculation that the next Fed move could be an increase in rates. We think that's very unlikely. We also don't believe that we're necessarily that the probability of a stagflationary environment is very high. But our expectations are that, as we've been saying for a number of quarters, that rates are going to remain elevated. I think the Fed is going to be a little cautious in cutting. Commentary out of Fed speakers, both at the chair and at the board member perspective, has been that the elevated rates have not done substantial damage to the economy, so it's not a great risk to keep them elevated for longer. I think we'll wait and see. That's being debated. We talk to managers on a weekly basis. I think they've adopted a relatively cautious approach to their current environment. While we've seen, especially we look at rates in the range that we've been trading over the last 3 months, it's a relatively tight range, but with a lot of volatility day to day. So we've gone to the extremes of that range multiple times, topping out and hitting the tights. The expectations going forward are that we will see maybe 1 to 2 rate cuts in the remainder of this year, with the first one coming in September. Again, that pricing changes on a daily basis with prints. We saw a softer jobs report. We've seen a little bit of progress on inflation. But the biggest challenge on the inflationary front is that, as I've said before, the low-hanging fruit has been harvested. What we have now is the sticky components of inflation, and it's going to be more challenging. It's going to take longer time for those inflation components to come down. And ultimately, we think that means rates are going to remain higher for longer. And what that means to economic growth is to be seen. As we know, tightening financial conditions take a number of quarters to play out in the economy. And Wilshire and staff have talked about on a number of occasions that the real impact of those higher rates, given the speed at which rates were increased, not a lot of sectors, or not all of the sectors of the economy, have felt that increase. A lot of people are still dealing, both on the consumer and the business side, are still dealing with, as we know, mortgages that were struck when rates were near zero. So we're still dealing with on the consumer side, still dealing with lower rates. They haven't had to really pay the higher prices associated with higher interest rates. And same on the business side. We saw a lot of loans refinance when rates were lower, and they haven't had to refinance. But some of that is starting to come due. We've seen that especially in the real estate sector. So our cautious approach when we rebalance the portfolio is to be opportunistic. We're not making substantial changes on a day-to-day basis, but we're taking opportunities as they're presented in the market. I'll pause there for questions. And if not, Sherry, we can go to page 57, please. Diving into the actual performance of the portfolios, for the quarter, the largest contributors to outperformance were the underweight positioning in core fixed income. As we saw, the core was one of the asset classes that had negative performance for the quarter. The overweight in public equities, as well as the relative outperformance of the real return and specialty credit portfolios. The most significant detractor here, the largest bar across the board in these graphs, was the relative underperformance of the private equity portfolio. compared to its benchmark. We discussed that really goes more towards the mismatch between the benchmark and the actual portfolio than an indicator of performance issues with that private equity portfolio. In the U.S. public equity portfolio, only one strategy did not outperform its benchmark, so exceptionally strong performance at the portfolio and manager level. And that one portfolio that didn't outperform its benchmark, it did perform in line with expectations given its factor tilts. So it was not an issue or a concern. It was expected given the tilts of the portfolio. In the non-U.S. public equity portfolio, relative performance was mixed, but skewed positive as strategies with modest style tilts performed better than those with a more aggressive bent. As we mentioned, non-U.S. markets underperformed U.S. markets, and certainly there was more mix between markets within the international equity space. Overall, stock selection was a positive contributor to performance, while the relative underweight to U.S. and relative overweight to the non-U.S. detracted from performance. The core fixed income portfolio outperformed its benchmark by 19 basis points during the quarter, with relative outperformance driven mainly due to the portfolio's higher allocation to corporate and ABS sectors compared to the benchmark. So as we know, spread sectors outperformed duration during the quarter, and the portfolio benefited from that. Fiscal year to date, the core portfolio has delivered strong relative performance, producing a return of 4.78%, outperforming the Bloomberg Aggregate Index by 222 basis points. Again, most of that performance was driven again by the short position that we had from a duration perspective for a number of quarters. So we're still benefiting from that performance on a fiscal year to date basis. The specialty credit portfolio produced a return of 2.58%, outperforming the blended benchmark, which returned 1.97%. And while the public high yield and levered loan portfolios performed well during the quarter, relative outperformance was driven by the private credit and multi-sector portfolios, with structured credit and mortgage-backed spreads tightening during the quarter. For the quarter, the real estate portfolio declined 4.24%, but was able to outperform its benchmark, which fell 5%. The portfolio has outperformed its benchmark by 76 basis points fiscal year to date, driven by good performance in our core strategies and our overall lower exposure to the most stressed parts of the market, including the office sector. So we're a much more defensive real estate portfolio than our benchmark. And that's been a conscious decision that we've made. Real estate has struggled. We think there's still more pain to come. If we look at especially in some of the higher price markets, we see secondary prices on some real estate transactions at very depressed or distressed levels. The real return portfolio performed well during the quarter, producing a return of 4.75%, which outpaced the 1.79% return of the benchmark. Fiscal year to date, the real return portfolio has produced a return of 11.36%, significantly outperforming the 4.27% return of its benchmark. Outperformance has continued to be paced by the portfolio's MLP exposure, which returned over 14% during the quarter and is up over 28% fiscal year to date, as strong cash flow, disciplined CapEx, and consolidation have continued to benefit the industry. The real return portfolio also benefited from the internal proxy portfolio, which returned 5.54% during the quarter. The private equity portfolio produced a return of 1.08% for the quarter, underperforming that public benchmark, which returned 12.01%. Again, that's the majority of the underperformance relative to the overall benchmark. Pause there for questions. If not, Sherry, we can go to page 69, please. Always some of my favorite Wilshire graphs. I appreciate them putting this together for us. And as we'll see across the portfolios, we've underperformed from a broad peer perspective over the last year as markets have gone up, especially public equities. And that's based on the lower risk profile of the portfolios. But they've continued to perform well, especially on a risk-adjusted basis. And what we focus on here is really that last graph, that Sharpe ratio. And across the portfolios, they've all produced top decile Sharpe ratios or risk-adjusted returns over the 3 and 5 year time periods. And that's really a testament to the durability of the portfolios. You know, the allocation that's provided by the investment committee and the board with that lower risk profile, but really being able to get the best bang for our buck with how we're investing. And that's both from an allocation and a manager selection process. Page 81. These graphs should look a little different than they have in recent quarters. You know, over the quarter, staff was able to make substantial progress moving all of the portfolios toward their new asset allocation targets. And as of the end of the quarter, only the cash position for the KRS pension portfolio was slightly outside of the IPS allowable range. And that can move day to day. Obviously, with contributions and distributions, that cash can move 2 or 3%. You know, and as of the end of the quarter, we were just outside of the allowable range. But as we scroll forward page by page here, Sherry, you'll notice that we didn't have any other asset classes in any of the portfolios that were outside of the range as of the end of the quarter. So we've been able to achieve that, I think, in a very prudent manner. Again, we didn't do it in a wholesale move. We took opportunities as presented by the market. You know, as I mentioned in the attribution, we remain modestly overweight public equities, given the tailwinds. You know, in core fixed income, we've moved towards the expanded targets, but we've done that when yields are higher to take advantage of where we see value in the market.
By the way, we just crossed 40,000 on the Dow. If anybody even believes the Dow is worth anything.
We should celebrate. It's monumental. We're back under for it. Sorry.
When I entered this industry 54 years ago, the Dow was 600.
You remember when they had the Dow 20,000 hats? They handed all the Dow 20,000 hats. I haven't seen anything for 40, but we're 6 points inside right now. So
they've got the hats. They showed the hats earlier. They're out.
Did they? I didn't get one of those. I need to get one. I'll put it next to my Lehman Brothers hat. Page 99, please, Sherry. The expanded and revised compliance report. We continue to make progress on this. Hopefully, it is you know, increasing visibility, transparency, and providing good information to the investment committee and the boards. As I mentioned, the only compliance issue to report as of the end of the quarter was the cash position for the KRS pension portfolio. All of the other positions were in compliance with IPS statutes and guidelines. Questions? If no questions, that's the end of my presentation for that agenda item. I don't know, Pruitt, if you want to move into next, which is the quarterly investment budget update.
You've got the floor.
All right, Sherry, we can go to page 127. Thank you. Through the first 3 quarters of the fiscal year, actual expenses continue to run well below the amount budgeted for the year, with only 41% of the budget spent to date. Contracted service expenses are in line with the budget. We've continued to experience delays in receiving the invoices for BNY, so the custody. So only 2 invoices are reflected as being paid so far this year, not 3 as we would expect through 3 quarters. Adjusting for this delay in timing, and approximately 70% of the services budget has been used year to date, so we're in line with what we budgeted. In the overall budget, the largest difference remains legal expenses and what would the actual expenses compared to what was budgeted, with only 23% of the amount budgeted spent so far this year. Legal, and Michael's on the call, they continue to tell me that we expect legal expenses to increase as litigation moves forward in a number of cases. So whether it's this quarter or into the next fiscal year, we expect legal expenses to increase in some cases pretty substantially.
Correct. And-
Vicky will answer that.
Yeah,
She's got the checkbook out, so.
Yeah, and there's been some recent activity, so by the end of the fiscal year, there will be some increases in this as well, but I think you're correct. Most of them are, it's going to start with the next fiscal year, but we are starting to ramp up. We already have some things for May. So I expect May and June to ramp up, but then it's really going in the next fiscal year.
Thank you, Vicky. Page 130, please, Sherry. Thank you. Fiscal year to date, total investment fees and expenses are running well ahead of the same period last year. As we know, there can be substantial volatility year to year, but they're in line with what we saw in fiscal year 2022. Investment management fees have remained stable across asset classes, with fluctuations, as you'll note, are driven largely by market value and allocation changes. Most of those fees are based on AUM, and as we move allocations or markets appreciate or depreciate, we'll see changes in those investment management fees. Volatility at the total fee and expense level has been driven by large swings in performance-based fees, with increases in the specialty credit and private equity classes and erosion of the real estate performance fees. The biggest thing I would note here is that we've seen a sharp rise in the miscellaneous expenses over the last year, and that's especially for strategies that rely on credit facilities. And obviously that's given the sharp rise in rates over the last year, the cost of those credit facilities has increased pretty substantially. And I would note that's especially evident in specialty credit and real estate. Obviously, the other side to that is that we're paying higher fees for those credit facilities, but the yields that those mandates are achieving, given the higher rates, more than offset and compensate for those additional costs. I also wanted to note that we're starting to realize the cost benefit of managing more assets in-house, specifically in core fixed income fiscal year to date. Management fees are approximately $250,000 lower than in 2023, despite the significant increase in total market value. I would note that miscellaneous 2023, you'll notice on the core line item, miscellaneous fees and expenses of $566,000. That's actually misclassified. That'll be updated in the next budget, but those are actually investment advisory fees. So, if we compare 2024 to 2023 fiscal year to date, that's, $1.6 million. So we're a little, about $250,000 lower in fees purely on investment advisory fees. And that's despite an increase of almost $500 million in market value for the asset class.
Any questions on the expenses here? Okay, we'll move on to the last agenda item. I think Ms. Hampton has asked for some clarification and maybe this committee to deal with the positioning, if you will, of the actuarial committee. And Michael, do you want to go through that?
Sure. So Sherry, if you can go to page 142 of the board books, it's on page 9 of the KRS bylaws. So you'll see here on the actuarial subcommittee is a subcommittee off of this investment committee. And if you look at the makeup, we've got a red line version here. It continues on to the next page. But the current makeup of what's redlined is that the actuarial subcommittee should consist of 3 members with the concurrence of the board chair as to each appointee, that the investment committee chair should appoint these 3 members, and they should be 1 trustee appointed by the governor, 1 trustee elected by the KRS systems, and then on the next page, it is 1 trustee elected by the state police systems. That's what's currently in there. The problem we ran into when we started looking at this actuarial subcommittee is that the trustee elected by the state police retirement system, Mr. Piercy, is not actually a member of the investment committee. And so we were like, well, then how's he going to serve on a subcommittee off of the investment committee? That is a little bit difficult. And so we started talking with Ms. Hampton about that. And so she asked us to do some work to revise this. And so this is what she asked us to revise, to include here that the chair of the investment committee shall appoint an actuarial subcommittee that's comprised of the 3 members of the investment committee who've been appointed by the governor to the investment committee. Or 3 members who've been appointed by the governor pursuant to the statute 645(1)(c). And so if you go back to that statute, what that relates to is that those are the 3 trustees appointed by the governor who have investment experience that are on the investment committee. And so that is the current proposal from Ms. Hampton, that the 3 members of the investment committee that have the investment experience will make up the actuarial subcommittee. And so that's the current proposal for amending the bylaws. She wanted us to bring that here to this committee, since you are the parent committee of the subcommittee, for discussion, thoughts, input, before we take it to the full KRS board at its June board meeting for consideration.
I think it probably makes, my thought is it makes some sense. People from the investment background are either directly or indirectly experienced with actuarial matters. But that's just my thoughts. Any other discussions? And it doesn't.
Yeah, Mr. Chair, I'm unfortunately on an airplane now waiting to take off, but I guess I would say if we're going to change it, it would probably be best to at least consider, and I'll be honest, I don't have any problem if we were to advance this as a recommendation, the suggested language, but to have maximum flexibility. So my suggestion would be this, that the chair of the investment committee can appoint a subcommittee comprised of 3 members with the concurrence of the board chair, and just leave it at that. So that it is possible that the members of KRS would elect a member who would have investment experience, perhaps even greater investment experience than a gubernatorial appointee. And so I'd want the investment chair to have the ability, given circumstances, political interests, to comprise the actuarial committee as they would choose with the chair's acquiescence. So I don't feel the need to specifically indicate superior knowledge is limited to just the gubernatorial appointees, but that's just my thought.
Well, I think I think it's a solid thought. If you have someone who has not on the investment committee, not a governor's appointment, sorry, and you can't have them on this committee, I think that kind of weakens the process.
I can definitely make that adjustment and just take out, as Mr. Allen indicated, simply make that adjustment to this drafting and have that. If that's what this committee would like me to do, that's why we brought it here for this discussion. So
I think making it a straight 3 appointments by the investment committee chair.
So should we take out that the actuarial is a subcommittee of the investment committee and just say it's just a committee appointed by the investment chair?
Well, I asked Ms. Hampton that, and she preferred that it be a subcommittee off of the investment committee, that the 3 members of the investment committee make up this committee, and that it be a subcommittee. So That was her preference as the chair of the board. But, you know, opening it up to all members of the investment committee is, you know, I'm fine with whatever you guys want me to go back and obviously present to the full board. And this, you know, this is obviously open for discussion at the full board. It's not simply this committee's choice on this bylaw amendment. So,
Okay, and I think I was confused. So Mr. Atkins was saying that he believes anyone from the investment committee could be appointed. They just don't have to be someone that the governor nominated. Is that
That's
correct?
right.
Okay.
Under the current rules, they're ex officio members that have to meet all these criteria. I just think maximum flexibility is always the better way to go when we change this. And assuming that the chair of the investment committee and the board chair concur, that's good enough for me.
I got it. I was confused. I got it now. Thank you.
Yeah, and I would agree with that. I think that's a reasonable approach. I don't think it needs to be the governor appointees specifically if the chair of the investment committee is going to make that assessment of who's appropriate.
Yeah, I think I would agree with that.
okay, well, I'll make that adjustment to the language that's currently there. And I'll let Ms. Hampton know how this discussion went. And then I'll get that adjustment drafted and have these red line bylaws prepared for the June KRS board meeting. So that's all I had on this topic, was just to bring this to you. I think on Mr. Lane, I think it's noted on the agenda as, you know, possibly needing a vote, but I don't think it needs a vote. Ms. Hampton said she just wanted some discussion from this board as to their thoughts on this.
Yeah.
So that we could give me some direction on how to go on what you all thought. So I've got that, and I'll go back and take appropriate action.
Thank you, and thanks for the comments. I agree that we were getting a little bit too narrow there, probably in the how this committee would be, the subcommittee would be formed. So I don't see anything else on the agenda other than the always popular adjournment. Could I have a motion to adjourn?
So moved.
And I'm sure there's seconds out there.
Second.
And with no objections, this committee meeting is adjourned.